Hi, everybody. This is Dale Brando with Stewart Advisors. Welcome to another in our ongoing series of webinars on topics of interest to our clients and other associates. Today, we're going to be looking at some strategies for funding college. To help me present, I'm joined by Tim Obendorf, also from Stewart Advisors. Tim and I hope to cover a lot of financial and data-driven material in the next half hour, but you should know that we also have a personal stake in this material. Both of us have kids that are either heading to college or recently graduated, so we have lived most of what we're going to be presenting to you. In fact, as we were putting this material together over the last few days, I was in the process of negotiating and navigating financial aid with one of my own kids, so it's all very fresh. So with that as an introduction, let's get started. Here's what we'll be covering in the next half hour. We want to do some initial conversation around the general topic of college costs. We want to say a few words about planning and how you can go about selecting the right college and how you can involve your child in that process. Then we're going to review some of the mechanisms at your disposal for funding college. We'll talk about the FAFSA, the CSS profile, those mysterious forms that might end up determining how much aid your child actually receives. And then along the way, we're going to try to point out some common sense planning that you can do to maximize your advantage in the college aid process. So at this point, let me turn things over to Tim.
Thanks, Dale. At Stewart Advisors, we work closely with clients to integrate financial planning and investment management, always keeping a focus on our clients' values. As we've worked with many clients over the years, one of the more complicated areas of planning has been the whole arena of college planning and funding. Every family's situation and values are unique, and there are a myriad of choices to make along the way. While we won't be able to cover every situation in this webinar, we hope you'll be able to we'll help you identify the questions you should be asking along the way. Not only have we helped many clients navigate college planning issues, as Dale mentioned, we also bring our own personal experiences to this topic. As we go through this complex topic of college planning, we'll try to keep the conversation practical by sharing our own successes, failures, or surprises that may help you. I'm guessing, Dale, if you could, there we go. I'm guessing one of the main reasons that you joined us on this webinar is that you understand college costs have risen much faster than inflation. There's several trends that have been driving this price increase. First, colleges have significantly upgraded dorm rooms, food service, and student services to compete when attracting new students. Second, the growth in student loans has meant the supply of dollars going towards schools has allowed schools to increase prices. And third, there's been a trend in higher education to use scholarships and financial aid to price discriminate. What I mean by that is that the published rates for tuition, room, and board have skyrocketed, but the actual average cost that students pay has not increased nearly as much. In the tables on this slide, you can see the published rates for tuition, room, and board compared to the average net tuition, room, and board after scholarships and financial aid. For private schools, the published cost has increased 53% in 20 years, whereas what students actually pay has only increased about 26%. The same trend is happening at public universities as well. Later in the presentation, we'll take a look at a net cost calculator to help you see how this plays out for a typical student. In our financial lives, we're constantly faced with trade-off decisions. Unfortunately, many families fund college without understanding the impact that it may have on the parents' retirement and other financial goals. Surveys show that about 1/3 of parents have sacrificed the success of their retirement plan by paying for college. In many cases, this isn't a conscious decision, as families make college choices without a lot of consideration given to the financial implications. In fact, only 18% of families surveyed limit the college choice based on the price. And while you can borrow to fund college, you can't borrow to fund your retirement. Because college is such a large expense, you'll need to start planning and saving as soon as you can. And we recommend that college finances be integrated into an overall comprehensive financial plan so that you can see how funding college will impact other priorities like retirement. A comprehensive plan will help you adjust to changing conditions along the way and minimize surprises. When our daughters were in high school, I heard a lot of parents express shock and surprise at how quickly college snuck up on their family. And the funny thing is that this is one financial obligation where you have at least 18 years of notice. Let's demonstrate the power of starting early to save for college. In this example, a family saves $4,000 per year and earns 6% on the investment. And if the family waits until their student is 10 years old to start saving, they'll accumulate about $46,000 by the time the student's ready to go to college. On the other hand, if the family starts when the child is first born, they'll accumulate almost $124,000 over 18 years. If the family starts late and wants to catch up, they may need to save nearly $11,000 per year. So that's quite a difference between saving $4,000 a year and saving $11,000. So the message here is to start as soon as you can. There are a lot of different and valid perspectives on how to share the cost of college with your student. Everything ranging from, I want my kids to have the opportunities I never had, to I'd like my kids to have skin in the game. Your family values should drive the funding conversation, but make sure that you have the conversation early, as it's not fair to tell your student they have to pay for a large percentage of college expenses at the last hour. Your family values will translate into various funding formulas, such as your student funds 100%, or the student funds some dollar amount or a smaller percentage, or the parents fund 100%. One of the benefits of having a formula is that it's much easier to communicate to multiple kids how you're treating them fairly. No matter what formula you choose, I want to offer two lessons that we've observed from the many parents we've worked with. First, don't sacrifice your retirement to fund your kids' college. And second, paying 100% of your kids' college expense may take some of the incentive away for your student to work hard and get good grades. To put the ability of students to fund into perspective, summer jobs could provide as much as $33,000 towards college. And here we do the math. So if your student works 40 hours a week, 12 weeks during the summer, and over 7 years between high school and college years, that adds up to 3,360 hours. And at $10 an hour, that's $33,000. And with conversations around increasing minimum wage, that could be as high as $45,000 to $50,000 at a $15 minimum wage. The funding conversation should also include a discussion about what counts towards your student's responsibility. For instance, if the student takes an AP course and gets college credit, does that count? What about loans or scholarships? In our family, we told our kids that scholarships counted towards their contribution. And when our kids realized that higher ACT scores could result in scholarship money, they really began to take the ACT prep course seriously. As you may know, May 1 is college selection day. And since Dale's family just went through the selection process last week, I'm going to turn it back to him to talk about finding the right college.
So I'm sure you're going to hear some of what I'm about to say from your kids' guidance counselors as well, but it's really important to define what you and your children are looking for in a college or a university. As the slide indicates, only about 59% of kids who go to a 4-year college actually graduate. Now, of course, completion rates vary widely across a lot of factors and, of course, by institution as well. But dropping out or even just failing to thrive often comes back to fit and not necessarily academics. So for that reason, it's really important to start figuring out what your child and you are looking for. So consider their personality type, the academic environment they need, and even the size of their peer group, and it'll make your search a little more efficient. To help them figure it out, it might be helpful to make a few exploratory visits close to home. So if you live in Chicago or another metro area, you can probably find examples of almost every type of institution nearby. Large versus small, public, private, religious versus secular, liberal arts versus university. And even if your kid has no intention of staying home near you or attending any of these schools, a quick visit early on can help them get a sense for what each type of institution feels like and where they might be the most comfortable. Now, once you have a general sense of what your child wants, it's helpful to make some first-round visits. Dropping by a college if you're on vacation in a town, or if you're in town for a travel soccer tournament, it's a good low investment way to start. Now, if you can, always register with the admissions office. They normally provide a student-led tour that lasts about 45 minutes and maybe a short presentation. This is almost certainly going to be better in terms of an overview than if you just showed up and looked around. And it has the added benefit of showing what's called demonstrated interest, which turns out to be very helpful if your child ends up applying. Most colleges also offer virtual tours on their websites or really well-produced media presentations that give you a sense for their campus and their culture. It's a great way to check out colleges that you can't visit. And also, I found them really helpful as resources to prep for a live visit. So for example, one college that we looked at had a really compelling video on their website about how they integrate the arts into campus life and all the opportunities that are available for students of any major who have interest. This turned out to be really interesting to my son, and we ended up asking some questions and having some conversations about it while we were on campus. Finally, in the early stages, it's a good time to consider all your options, including community colleges or even online opportunities. So according to one study, about half of all students who earned a 4-year degree spent at least some time in a 2-year institution. Community colleges can be a great stepping stone for kids who aren't sure or aren't ready for a full university experience, or they can also be a cost-effective way to accumulate a few transferable credits. And just as an aside, for those of you who live in Chicago, if your son or daughter is a pretty strong student, you should know they can qualify for tuition-free access to any of the city colleges through the Star Scholar program. And there are 30 4-year institutions that partner with city colleges at some level to offer transfer credits, scholarships, and various other forms of assistance. So just something to keep in mind. So let's talk about some specific college funding strategies. There are a lot of different vehicles available, so to avoid making this a 3-hour presentation, we're going to concentrate on a couple of the most commonly used, widely available tools. And 529 plans are probably the most well-known tax advantage savings program. Coverdell education savings accounts and certain types of U.S. savings bonds also fall into this category, but 529s are probably the most well-known. Each state offers its own 529 plan. If you live in Illinois, the college savings plan is usually known as Bright Start, or in some cases, Bright Directions. And there's also a prepaid tuition program that falls under the 529 umbrella called College Illinois. So for this discussion, when we say 529, we'll be talking about college saving plans like Bright Start. 529 college savings plans are really popular because they offer a lot of attractive benefits that almost anybody can use regardless of income. There are no phase-outs. Funds that you contribute to a Bright Start account accumulate earnings tax-free. Sorry about that. And there's no tax on the withdrawals you take as long as you use them for qualified educational expenses. So one piece of good news is that the definition of a qualified educational expense is pretty broad. So it includes a lot of incidental expenses beyond just tuition. Another feature of 529 plans is that you can choose from an array of investment options for the money that you invest, including targeted funds based on your child's age and expected matriculation date. And one final thing that makes 529s attractive is that while the contributions aren't federally tax deductible, the contributions to an Illinois Bright Start account are deductible from your Illinois income tax, up to as much as $20,000 per year if you file jointly. So this means that even if you haven't started saving for college early, you can still get some state tax benefit by running your college funds through a 529. And incidentally, state tax benefits are only available to residents who use that state's 529 plan. So there's some advantage to opening an Illinois Bright Start or Bright Directions plan versus another state-sponsored plan if you live in Illinois. And if you live out of state, it may be advantageous to open a 529 in your state of residence. So of the financial aid available, scholarship aid is probably the most beneficial since it doesn't get paid back and it often is renewable for all 4 years. Now there's no standard format for the financial aid letter that your child will get, but typically they start out detailing the full cost of attending the college And in the next section, they show the scholarships and grants that the institution's offering. Scholarships are based on merit or some other special criteria. Grants are similar to scholarships. However, they usually depend on financial needs, so they will be recalculated each year in most cases. And they could vary depending on how your income flows. And once you've considered scholarships and grants and personal savings like 529s, loans are the next level of funding that most people turn to. And there are lots of different types of loans, but generally they fall into three categories. The first are direct federal student loans. These are funded by the Department of Education, but they're delivered through the individual institution that your child attends. They offer low interest rates, no credit underwriting, and very favorable loan terms like repayment based on postgraduate income. There's also cancellation and deferment options for certain types of employment or other programs. Direct loans can be deferred while your kid's in school until 6 months after graduation. And if the direct loan is subsidized, the government pays the interest while your child's in school and it's deferred. If it's an unsubsidized loan, the payments are deferred, but then they end up being capitalized and added to the loan later when payments begin. The other category of federal loans is direct plus loans, or sometimes you'll hear them referred to as parent plus loans. These are issued to parents of undergrads to cover the contribution to the college cost. Plus loans are also distributed through the school your child attends. And as you can see from the slide, the interest rates are higher, but generally still attractive compared with private loans. The loan terms are also favorable, but there is credit underwriting, and payments usually can't be deferred. The final category of loans is private, and there's a wide variety of rates, terms, and fees that are associated with them. So that's an investigation that you'll need to do into the market at the time that you're seeking funding. Work-study programs are another piece of the aid package that most colleges offer. They are federally funded, and they provide kids the opportunity to work on or near campus and earn a significant portion of college costs. The exact amount that's available, which is the work-study award amount, is set based on need, course load, and academic progress. And finally, it's not technically a source of funds for college, but we wanted to make you aware that there are a couple of tax credits that you might qualify for based on the college expenses you pay. The American Opportunity Credit and the Lifetime Learning Credit each give you a tax credit of differing amounts. Unfortunately, you can only claim one or the other in the same year, but the American Opportunity Tax Credit is up to $2,500 per student per year, while the Lifetime Learning Credit is a once per return credit of $2,000. So the amount of credit both of these offer is based on qualified higher education expenses that you pay, and both of them have an income ceiling. So that is, they're not available if your income exceeds a certain threshold. Now, obviously, the American Opportunity Credit is more generous, and that would be the credit of choice if you have the choice. That said, the eligibility criteria are a little tighter, and it's only available for 4 years of college. The Lifetime Learning Credit, as its name suggests, is available for life, and it's broad enough to cover expenses like job retraining and other education items that the American Opportunity Credit doesn't apply to. So when the time comes, you'll need to look at which of the two credits you qualify for based on your income, your actual expenses, and other factors.
So one of the questions we get asked in the planning process is, what is college going to cost for my kids? And that's really a difficult question to determine because many and possibly most students don't even pay the published cost of college. To help families determine college costs, the Department of Education began mandating in 2012 that colleges include a net price calculator on their websites. And while it's not a commitment from the school, this is a quick way to get a realistic estimate of college cost. One thing to emphasize is that before you rule out any schools because of cost, make sure you complete the net price calculator for that school. So in the example here, I entered some demographic data into both University of Illinois and DePaul University's net price calculators. So the box on the right-hand side, you can see the criteria, the income of the parents. This is an Illinois resident, 4 household members. And you can see the major and the GPA and ACT scores. So all of those go into the net price calculator. And what you see here is that while the published cost of DePaul is significantly higher than that of U of I, the net price is not that different. And particularly for private schools, you may find that a school that you thought was outside your budget is actually affordable. One comment about the calculator is that many schools' calculators will show that you can cover the net cost through loans, work study, or other ways that are not grants or scholarships. So just be aware of the net price calculator that shows a net cost of 0, as many times much of that cost may be loans. Now, one of the most mysterious parts of college admissions is the FAFSA. And FAFSA stands for the Free Application for Federal Student Aid. And the goal of the FAFSA is to come up with an index number that puts all families on an equal scale for financial aid. When you complete the FAFSA, you'll get a number called the expected family contribution. This isn't necessarily what you will pay for your student to attend the school, but it's a number that the schools will use to determine your financial aid package. Let's take a look at what goes into the FAFSA. The items that add to the expected family contribution are parent income, student income, grandparent 529 withdrawals, and a percentage of certain parent and student assets. Things that detract or take away, reduce the expected family contribution are the size of the household, the number of students. And there are some items that are not considered in the expected family contribution, such as retirement assets or family business equity and home equity. I do want to mention, and we'll get into this a little later, there is another financial aid calculation called the CSS profile. CSS stands for College Scholarship Service. And that profile is used by some elite schools. And you should know that some of the excluded items that don't count in FAFSA do get included in the CSS. My goal here is not to make you experts on FAFSA, but to show you that there are some planning opportunities to minimize the expected family contribution and maximize financial aid. So for instance, if your student has a 529 from a grandparent, you'd be better off delaying using funds from that 529 until senior year, as there won't be another FAFSA calculation that includes that withdrawal. Many of these planning opportunities take some time to implement, so it may make sense to complete a sample FAFSA calculator when your kids are junior high age. And that way you have some time to make plans to maximize your family's chances of getting financial aid. Finally, you may think that you make too much money or have too many assets to make filling out the FAFSA worthwhile, but don't let that stop you, as you might be surprised at how much aid is actually available. In addition, if you plan on taking out federal student loans, completing the FAFSA is the trigger to start the loan process. Although a majority of the schools rely on the FAFSA, there are 250 to 300 schools that also use the CSS profile. Neither of the schools that my kids went to participated in the CSS profile, but Dale has some recent experience with the CSS. I'm going to let him talk about that.
So the CSS profile is a form that you might need to complete in addition to FAFSA. As Tim said, I counted 246 schools on the College Board website that require the CSS. Most of them are private, and unlike the FAFSA, it's offered through the College Board for a fee. So I think it's $25 to complete the CSS and send it to one school, and then $16 for each additional school. Basically, FAFSA was designed as a qualifier for federal student aid, and CSS profile was designed as a way to help universities divvy out the institutional aid that they provide. It contains a lot of the same information as the FAFSA, but the CSS digs a lot deeper into your child's financial resources, and by extension, your resources. It also can contain some supplemental questions that are specific to a particular college or university. Unfortunately, completing FAFSA or CSS isn't an either or. If the CSS is required, it's almost always in addition to the FAFSA. Now, on the slide, I've listed a few differences between the FAFSA and the CSS. As I've mentioned, the FAFSA is for federal loans and aids, so your CSS profile isn't going to have any impact on those particular funding mechanisms. It does dig further down than the FAFSA. So, for example, a non-custodial parent in a divorce situation may need to file their own CSS profile in addition to the one that the custodial parent files. The CSS also asks detailed questions about your home, family business, or a farm if you have one. And it asks about 529s or other assets held in your child's name by other adults. In addition to collecting detailed data on your financial position in the most recently completed tax year, it asks for a 2-year forward-looking projection of how your financial situation may change over the next 2 years. On the positive side, the CSS does ask some questions about significant expenses that your family might have. So it asks about elder care or large medical expenses. And finally, I thought this was very interesting. It provides a text field at the end where you can supply any additional information that you think is relevant to college financial aid officers. So there's an opportunity to explain any extenuating circumstances or issues that might impact your family's ability to pay. So before we end and take some questions, I'd like to summarize some of the planning that you can do to help maximize the financial aid your child receives. To some extent, this situation is dependent, and whether your child's college or university collects the FAFSA or includes other data like CSS could play a really significant role. That said, in general, need calculations tend to look more at income than assets. So it makes sense to minimize distributions other than income to the extent that you can without impacting your family's life or financial health. Also, distributions from a 529 or other savings plan from a grandparent or a relative count as student income. So as Tim mentioned, holding off on distributions until after the final tax year that's considered in financial aid calculations could help. Assets do matter, so it makes sense to plan in this area too. Clearly, it doesn't make sense to accumulate excess cash or trade non-countable assets for those that matter in the financial aid calculation. Also, if you're going to be tapping home equity to fund college, consider a line of credit versus a loan, since excess loan proceeds could be counted. It also might make sense to pay down debt in the run-up to college. And finally, if you're charitably inclined, making a contribution is a good way to lower countable assets. Finally, a couple of miscellaneous tips. As I said earlier, there's some overlap between FAFSA and CSS, so make sure the information that you provide on both forms is consistent. Also, just like paying down debt, it might make sense to accelerate necessary expenses like buying a new car to reduce your countable assets in the run-up to the college financial aid process. And finally, as you begin to plan for college, there might be an opportunity to shift ownership of some reportable assets in certain cases. So we're going to stop there and take some questions. We have a few that were submitted along with registration, but if you have more, feel free to use the Q&A button to send us any questions you might have. Also, while you're thinking about that, if you'd like to talk to us about this or any other topic, you can use the Q&A buttons to let us know, or you can just reach out to us. We're happy to talk with you. And finally, printed on the slide are some resources that we found that are particularly good. There are lots and lots of others on the web as well. Studentaid.gov is a Department of Education site with a wealth of information. The IRS publication 970 is actually fairly readable for a government publication, and it has a lot of information on the various tax benefits that are available. So just some things for you to consider. So with that said, let's take questions at this point. So one that has been submitted is, the question is, do I need to buy an Illinois 529 in order to take advantage of the Illinois tax deduction? Or is another state's 529 plan going to work for me?
Yeah, Dale, I think you mentioned this, that Illinois does give a deduction for 529 contributions, but that's only for contributions to Illinois' sponsored 529 plans. So the majority of states do give a similar deduction. So you want to look, if you don't live in Illinois, you'll want to look at your state's sponsored plans and look at whether your state has tax deduction available for 529 contributions. So there's definitely an advantage of using your own state's 529 plans.
And here's another question that was submitted with registration. Someone was asking, are there any recommended alternatives beyond the standard 529 plan for saving for college education?
Yeah, so I would say one of the reasons the 529s have become so popular is that they really address most of the planning situations or most of the needs for saving for college. Obviously, there's some other strategies, other things that you could use. You could save in a regular savings account or in a brokerage account. There are some strategies where you might use a Roth IRA to save, but know that when you pull the money out, that becomes income that could be added back into your FAFSA calculation. So there are a number of alternatives, but I would say the 529 is the most frequently used and the most successful program for college saving, just because you do get the tax deferred benefits and it's easy to set up, easy to use. Other plans, I would say, are possibilities to take a look at, but it really depends on your family's specific situation. But we're seeing in most cases the 529 is a great savings tool.
Here's another question that's fairly specific. Do you have any recommendations for wealth planning for a Chinese family, immigrant family specifically? So are there any, college planning or general wealth planning issues that would apply there?
Yeah, I think the general college planning issues are going to be very similar. Whether you're third or fourth generation citizen or a new immigrant. Probably the biggest issues come in the area of just how do you help your student best transition, especially if you haven't had previous generations in your family go through the U.S. higher education system. So, everything from the application process to the financial aid process is going to be new. And so because of that, I'd really recommend tapping into expertise of advisors that are around you. And that could include your high school, college guidance counselors, your financial advisors, and even as you get further in the process, building a relationship with the college admissions resources of specific colleges that you're looking at. Some of the especially for first generation college students, some of the biggest issues are just the cultural transition. And so finding a place at the school where the student fits in and finds other folks that are in a similar situation. So a lot of schools have clubs and resources for either first generation college students or people from immigrants from specific areas. So take advantage of those programs just to help the student transition well. But overall, the financial and application planning is going to be very similar. It's just a new process with a lot of different facets to it. So take advantage of advice that you can get.
Okay, well, we're running just a tad long, so I guess I'll call for any more additional questions before we wrap up. Okay, looks like there's no more questions, so I will thank everyone for joining us this afternoon. And again, we will make this webinar available on our website, stewartadvisors.com. Thanks.